So, one of the biggest questions is having to do with inflation and what plans to make for the future of prices. A lot of really good information about the future can come from analysis of the past. One of the biggest high profile items included in inflation news is gasoline prices. And gasoline prices having gone up dramatically in the last few months reminds a lot of people of what happened in the 70s. And people are expecting that gas prices are going to go down and it's just a temporary bubble, and they're looking for the day when they can have their monthly gasoline budget for their vehicle back to where it was in 2018 or 2019. And history shows that, like most items that incur inflation, this may not happen. And here's why. Here's a chart of gasoline prices going back into the 1960s. This is more than 50 years ago. And for the longest time, the price of gasoline, as you can see from this chart, was in the 30-cent range, 31, 30, and it stayed in the 30-cent range for decades up until the mid-1970s. And you can see in 1973 it went up from the mid to low 30s to 39, and then right away in 74 it went up to 53 cents, which of course anybody now would love to pay 53 cents. However, this was high at the time. This was an increase of, from 38 to 53. That's more than 20% increase. That's like gasoline going from $4 to $5, which is kind of like what happened here in the last year or so. And then the next year was 57, 58, 77, 62. And that was when the big jump happened. Even into the late 70s, it went up again to 86. So if you look at this from, let's say, 74 to 79, 5-year period, it more than doubled the price of gas. That's kind of the change we've had in gasoline in the last 2 years. So what happened after that? Well, it continued to go up over $1, $1.19, even into the 80s. And it remained that high until 1986, and it did go down slightly. It went down from $1.12 to 86 cents, 90 cents, and then in 89 back up over $1 and then climbed again. So what does this show? There may be a temporary slight pullback in the price of an inflated item, whether it's gasoline, food, real estate, vehicles, but it's not going to go back down to where it was historically. So what might happen with gasoline is it went from, let's say, just under $3 a gallon, $2.50, $2.60, back in 2018 or 19. Now it's up in the $4 to $5 range, depending on where you live. It may go up to 6 or 7. It may pull back slightly, back down to 5. But inflationary prices on any type of commodity or product is what's called ratcheting, meaning that once it ratchets up to a certain point, it's going to lock in at that point. It may drop down a little bit, but it's not going to go dramatically back down. This is different than the stock market. Stock markets can have wild swings. Commodity prices and product prices for consumers normally have a ratchet effect where once they get clicked past a certain point, they're not going to go back down, because unlike traders of stocks who are looking at an investment, purchases of retail products, gasoline, food, clothing, vehicles, are done by consumers who are a one-time purchaser of this product, and it's consumed. It's not retraded to somebody else. That means that once the price has been established that people are willing to pay that price, the manufacturers and the sellers understand that they can sell it for that price. They don't have to go back down because it's not being resold. Stocks can go up and down because once you own a stock, at some point the only way to get your money out of that stock is you sell it. So if you buy a stock for $50, it goes up to $60, you sell it and get your cash. If the stock goes down to $30, you need to sell it to get your cash, whether it's to prevent other losses or to use the cash for something else. If you buy a gallon of gas, you're not going to resell it. Once it's purchased for $5, you own it and you use it. So the volatility of stocks is different than a purchased item. It's not going to be something that goes down dramatically. What does that mean for a consumer? Whatever prices you're seeing in the marketplace, expect that it's going to be in that range. Might there be a little bit of a pullback, a little bit of an easing, just like we saw in the late 80s, 86, 87, 88. It went back down under $1, but then it went right back up over $1. And if you look, it's been over $1 ever since. And then in the mid-2000s, it went up again into the twos. So gasoline prices is a good historical indicator of what might happen in the market for every item that we're seeing in the consumer market. And understanding the ratchet effect of consumer products and goods and understanding how it affects your budget will help you make plans for the future. If you're making plans now for 2024 and 25, if you figure expect gas prices will be $5 or $6, you can adjust accordingly and plan your life accordingly. Maybe it means that you negotiate work from home a few days a week. Maybe it means that you don't have a long distance travel every day if you're worried about gas. If you don't care about gas, then that's not a factor. But any of the items you have in your personal household budget, if you look at the new reality of this as a permanence, not a temporary or transitory event, it will help you make plans so that you can adjust your life accordingly. Not that we agree that the prices should be this high, right? It's not a matter of opinion about what the price should be or an opinion about why the prices are higher, whose fault it is. That's not the point. Or even relishing in the fact that the prices are higher. Nobody likes the fact that prices are higher. We're just talking about how you react as a consumer to the reality that prices are at the level that they currently exist, and predicting the future about where they're going to be so you can create a life accordingly with income, with employment, with cash management. Because if gas prices were just going to go up to $5 or $6 and then go back down to $2 or $3, you could look at this as, well, temporarily I just have to pay this extra money and maybe cut back on something else, or maybe not save as much, or maybe look at the fuel as an expense as a higher amount versus maybe entertainment as a lower amount, and plan in a couple years it'll be back down to $2 or $3. According to history, but also according to the reasons why consumer prices don't go back down, it's very likely that the establishment of gas prices at their current level is kind of testing the waters. It's a proof of concept from whoever is deciding on these prices that this is the amount that consumers will pay. There may be other factors involved, the reasons why they want the prices higher. But for whatever reason, that's where the price is. And that's what you're paying. Wishful thinking that it's going to go back down and your budget will be back to where it was is not going to change the fact that history and the reality of the marketplace indicates that it's going to stay where it is. So hopefully you can be a consumer and an intelligent planner to use the information about the market to act accordingly. And while everybody else is saying, well, I'm going to lose $200-300 a month on gas and maybe I'll go negative on my budget, but it'll change, they are not going to have the responsiveness that you might have, knowing that the future holds that this is how it's going to be. Maybe you buy a vehicle with better fuel economy. Maybe you take other action to consolidate trips. But if you have the knowledge of what the budget's going to be in the future, you'll have already been set up for it, where most people will be just reacting to it in the present time.